Welcome to episode 62 of the Cashflow Connections podcast. Our topic for today is how to avoid six-figure mistakes and generate more passive cash flow. Today, our guest starts out the conversation by sharing with us how he made virtually every mistake you can make as a first-time real estate investor and how those mistakes shaped his thinking for the remainder of his career. But it's not just a sob story. Our guest is now a very active investor and syndicator, so we also learn some of his perspectives and strategies from investing at a high level in this industry. So in this episode, we're going to discuss, number one, why it's so common for conventional wisdom to be wrong about the financial sector and where smart investors should be getting their information from. We're also going to talk about why it's so difficult for highly skilled and high-paid professionals to really see the big picture, play the wealth creation game optimally, as opposed to just increasing their income and then simultaneously increasing their expenses, so they're really not getting anywhere. Then we're going to discuss some of these mistakes. Our guest suffered from a pretty unique instance of fraud, and based on this conversation, it's actually quite challenging to avoid this completely, but there's a few strategies you can implement during your due diligence process that can mitigate the chances of this happening to you. And that's really the type of advice that we want to share with you. Then we're going to talk about some of the wins. We're going to talk about what things are working well for him, what his perspective is in terms of where the real opportunity is. And we're going to talk about a variety of other wealth creation tools such as infinite banking and mastermind groups, and really just everything out there. This is the Cashflow Connections podcast. It's open format. You know the deal. Also, just a reminder, if you have listened to a few episodes and have enjoyed the content, don't forget to leave us a review in iTunes. One of the ways that we're able to get high-quality guests on the program is by potential guests seeing that there's a lot of interaction with the listeners. So reviews make a big impact. It's free to you, but it will help the show significantly. So if you haven't yet, make sure to go to Cashflow Connections Real Estate Podcast in iTunes, leave a review. Doesn't have to be anything special, just an honest review of the program. And if you then screenshot the review and send it to me at info@cashflowconnections.com, I'll send you a free ebook on commercial real estate due diligence, just for being cool, just for being a fan of the program. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Buck Joffrey, who is a surgeon turned serial entrepreneur, asset manager, and podcaster. Buck finished his surgical training in 2008, and since then, he has started multiple 7- and 8-figure businesses and has amassed a substantial portfolio of investments in the real estate, energy, internet, and health sectors. Dr. Joffrey is also a financial educator. In fact, he's the host of the Wealth Formulapodcast, which is an international #1 best-selling author of 7 Secrets of Eternal Wealth. His mission is to provide financial education, particularly for high-paid professionals. So, Buck, awesome intro. Really happy to have you on, and thanks again for coming on.
Thanks for having me.
So, you obviously have a really interesting background. I think your story is something that some people can really, really relate to. Let's talk about that and how you end up transitioning into being a passive investor and a podcaster.
Yeah, I mean, for me, I started out sort of on the pathway of being a good student, wanting to be a good student, getting good grades, doing well in college, going to medical school. And, when I was going to medical school, my whole, the thing that drove me was what is going to be the most powerful sounding and cool thing that I can say to other people. So I started a neurosurgery residency so I could tell people I was a brain surgeon. And, basically that was, I tell you this sort of tongue in cheek, but it's reality. I mean, I was kind of on this, this path that a lot of people are on where they just, they get this Pavlovian feedback of success over a period of time. And then they just keep looking for more and more things that will provide them kudos. So that was the world I was living in. I ended up switching residencies, ended up doing different kinds of surgery, ended up with some cosmetic surgery training as well. I was a very academic guy, and I published a lot of papers, wrote a lot of chapters, et cetera, et cetera. And so pretty much anybody who knew me back in medical school or even residency would have pegged me for going down the chairman, becoming a chairman somewhere someday, that kind of thing. But what happened to me was towards the end of my residency, I got really burned out of academics. I just thought it was a very hypocritical, and I didn't like my residency program because it was so hierarchical. And so when I finished my training, a funny thing happened. I got married the day after training, and my wife and I went to Mexico for a week. And on the way home, I picked up a book, and it happened to be, and I picked this book up from a Puerto Vallarta airport. And there was like 3 books in the airport, and 2 of them with guys with long hair and blowing in the wind and no shirts. And then there was a Cashflow quadrant. I had no interest in money, but Robert Kiyosaki's Cashflow quadrant sounded it was the only palatable book there for me. So I grabbed that, got on a plane, read it on the plane. And when I got off the plane, it was like I had been hit by lightning. For me, it was a very dramatic moment because I had never occurred to me that there was a world outside my world at that point. And this world of entrepreneurship and investing and things like that, where you could take your fate into your own hands and, be somebody who could expand and do whatever they wanted. This whole world was like brand new to me. It sounds crazy, right? But throughout my entire life, and I remember thinking, what am I going to be when I grow up? Well, what am I going to be really meant? Who am I going to work for? And it never occurred to me that I could do my own thing. And it sounds just stupid to me right now, but that's the way my brain worked. And this completely changed it. But that's how it began. And so then, I had training and I just really went an entrepreneurial route. And that led to me making more money than most of my colleagues. And that led me to ultimately figure out, well, hey, at this point, I'm already got the Kiyosaki bug. My dad put me through, all my school as a real estate investor himself. And I always kind of looked down at him for it as not doing something important, but also came around to the idea that, hey, you know what? I never wanted for anything. So I went down the route of becoming an investor in what I call real assets. And I guess the rest is history.
Yeah, I really appreciate you sharing that story. And it's fascinating how many people were so significantly impacted by Robert Kiyosaki and those couple of books. I know that he's put out several, but I know that 2 in particular, Rich Dad, Poor Dad, and the Cashflow Quadrant. If anyone's listening that hasn't read those, it's a very straightforward approach. But for someone like me, and it sounds like you as well, if you have a simple, straightforward approach to a document and you haven't been exposed to that type of thinking, it's like you can have this mind mold situation onto something like an airplane, which I have done also. I like to read a lot when I travel. That's exactly the type of stuff. It's like going to a boot camp while you're on a plane, basically. And it's just remarkable how much of an impact that book has had and he's had on people. One of the things that you talk a lot about is the golden handcuffs of those hyper skilled laborers that really found their place in the workforce. And it sounds like you were almost going that route and end up making that shift at the last minute. What do you attribute a lot of that to? Why do you think that that's so common, particularly in, you mentioned neuroscience, for example?
Well, I mean, I think, again, when you're a highly trained professional, whether you're a lawyer, a doctor, or whatever, maybe you're a software engineer, some of those guys, whatever, but a lot of us go through a period of time of suppressing our own desires of having things. For me personally, coming out of college and being in med school, I mean, a lot of my friends went off to work and became, they went to Wall Street and worked with private equity or hedge funds or whatever, and they were making, hundreds of thousands of dollars, and I was still making like 40, 50 grand a year as a surgical resident. And I think a lot of times what happens is that when you get done with a long training or any specialized training, you want to, sometimes you say, well, gosh, I really like a house and I'd really like a car and I'd really like this. So what happens is that you start making more money, but it's almost like you're somebody who won the lottery, right? Where you're going to increase your own expenses specifically to match exactly how much money you're making. And to me, that's what happens. It's the golden handcuffs in that regard. Now, part of the problem there is that for somebody who's never had a lot of money, it's a completely brand new experience, right? So what do you do with this? And it'll be curious because you've got a lot of these kinds of things happening right now. One of my interests, a side interest is in blockchain and distributed ledger technology. And you've got these people who all of a sudden have $25 million of Bitcoin and they have no other money. are you going to, it'll be curious to see how many of those people just lose their money, right?
Yeah.
But you have to get into a different mindset. The mindset is, okay, well, now I have money. Now what do I do with it? Money is not there just purely to spend. I mean, when you barely have any money, that's what you think of. But when you start having more of it, you have to change a mindset. You have to start thinking about preservation and growth and things like that. And I think when you go through, college and medical school and residency and all of that, and you have no money, you have no framework for it, right? It's almost like you never really expected to have any money, and all of a sudden you do. I think the golden handcuffs ultimately comes out of that. And really what it is now you want more stuff, so you just keep working harder and harder. And now you may even hate your career, but now you have to work because you have raised your own overhead to such an extent that you couldn't quit. You couldn't even slow down if you tried. And that's what I call the golden handcuffs.
Yeah. And there's actually more people than I think a lot of people understand that are, let's say, making $500,000 a year in income. That can be eaten up very quickly if you consider taxes, number one, and then number two, expenses. You have an extra house, have a couple extra cars, $20,000 a month in expenses. That can happen if you just don't pay attention. So then you have someone that's making $500,000 a year that's literally no closer to retiring than someone that's making $50,000 a year. It's remarkable. So that's actually a good segue into kind of the discussion about investing as a whole. So obviously the way out of that situation is a combination of saving and investing. So talk us through when you tried to, or when you were in the process of making that transition, what were some of the first investments you made, whether it was real estate or otherwise?
So what I did was, as soon as I read Robert's books, I picked up Ken McElroy's book and tried to learn about real estate. Of course, my dad had been doing real estate my whole life, but again, being, one of those snotty, smarter, kids, I didn't really think of, learning from my dad necessarily was the best idea, besides the fact that he was more of a, kind of a typical landlord. And I didn't want to be a landlord. So I read Ken McElroy's books, ABCs of Real Estate and all that. And I thought, boy, this is pretty easy. I mean, the math is really easy here. And of course, I just thought, well, I can do this on my own. So I just went to the internet and started searching for properties. And, it sounded like the cap rate was the thing to look for. So I went on LoopNet, where deals go to die.
Right.
And I searched for highest cap rates, and that found a building in the South Side. And it looked like it was a high cap rate. And I just bought a multi-million-dollar house in the North Shore of Chicago. And I said, oh, I need a broker, so maybe I should use this guy. So I used my luxury broker to go down to the South Side of Chicago. I did every possible thing wrong. If it wasn't in Ken's book, I pretty much didn't do it. So Ken's book will tell you everything you need to know about the math behind real estate, right? But there's a whole world behind it that I learned in a very expensive mistake in short order. So I did everything wrong. I, found out that this building I bought was, the rent roll was padded, and there was fake tenants in there. And the property management company was actually owned by the previous owner who owned multiple buildings around there. It was a big, big, horrifying mistake. And it was a very expensive mistake, but I learned an enormous amount. It just cost me several $100,000. So,
yeah, well, it's fascinating. I think that the advent of the internet and particularly podcasts, people listen to that now. That sounds kind of ridiculous, right? I mean, no offense. I think you would probably agree. But the amount of education that's available right now because of programs like this, because of programs like you, that sounds kind of crazy in the sense that going to LoopNet and then searching by sort from highest cap rate. It's like going to Amazon and saying you want to buy an iPhone and searching by lowest price and just buying the first thing that happened. Oh, you got an iPhone case for $3. Like, that's exactly what that was doing.
Yeah.
People like that were doing that.
Yeah. I mean, honestly, I think, again, it goes back to this idea of there's some level of hubris when you are, in the position I was in, the academic position where, and I think doctors as a whole suffer from this a little bit too. It's like hubris. You think that just because you're able to master things that people think are complicated, that you look at things and you're like, I can do that. That's easy. And you don't really look for a lot of help. You just buy a book and you try to do your own, and it doesn't go well. But yeah, you're right. I mean, I didn't know about podcasts. I mean, I was just basically reading books and, reading some books, and they really just focused on the math. But yeah, that's what happened.
Question, what were some of the things that functionally went wrong? Well, once you bought that property, when did you start to realize that you had made a mistake, and what did that result end up being?
Well, I mean, the biggest thing for me was I think my due diligence was probably a little bit inadequate. So what happened was that this property that was supposedly, if you looked at the, in retrospect, if you looked at a T3 or a T12 or whatever, was doing fine. It was cash flowing fine. But as soon as I bought the building, everything fell off the cliff. And, I think, this transaction was not big enough probably to turn it into, a huge lawsuit because, as you know, that in of itself has tremendous expense to it. But I think basically what happened is the books were manipulated. I mean, we had a landlord who had multiple buildings in the area who was using rent from other buildings and saying that it was coming from this building. He even had fake tenants in there who was letting live for free, even though the rent that was marked for those tenants was not coming from them. It was, that was kind of the crazy thing that happened. So when I realized that, suddenly there was no income and I was paying out of pocket to cover the mortgage, I realized something was wrong. And I think that's where, getting, it's a long story, but the bottom line is I just realized that, I'd just been had. I'd made a mistake, and there's a million different things I could tell you I would do differently at this point. But they all, sometimes these kinds of things are good to happen early on, so that you learn from them and then you can move on. I mean, I have done several $1 million of real estate transactions since then, and I've never, thank God, I've never lost money. But that's not to say I can't. But sometimes you need to learn from mistakes, and that's what happened to me.
It's obviously kind of an interesting situation. Obviously, they're basically committing fraud.
Right.
Saying people are paying rent there, they're staying for free. What could you have done to limit the risk of something like that? Because even if you were to walk the property, you would see that the tenants were there, even if they weren't paying rent. What would be the way that you would kind of limit that?
Well, so now I'm going to go, because now we're fast forwarding, like a decade, right? And you learn a lot in a decade. And, now I would consider myself, as sophisticated as pretty much anybody else in the real estate world. So I can look back and I can say, well, there's multiple things I could have done. One is that on a very basic level, I mean, you could use something like an estoppel certificate type thing where you basically have to go from, you get this legal document from every tenant saying that they live there and that they pay rent. That's a very basic thing that could have been done that I had no idea anything about it, right? I mean, most of us probably when we're buying real estate don't do that. I mean, maybe you do. I don't know. I didn't do that. But I think from a larger perspective, what I realized was that generally speaking, I think it's dangerous to buy any property that doesn't already have, sort of a third party manager in place. I think that, it's very hard if you've got a larger asset, a couple hundred units, 200-300 units that has professional management in place. It's very difficult to fudge those numbers, right? It's a much bigger deal.
Agreed.
To create that kind of fraudulent activity. But listen, that is, and that's one of the reasons I've shifted very much. I mean, I bought several apartment buildings in the last decade, and now I'm sort of exclusively in the larger assets. But I think if you look at it, here's a very good parallel, I think. So I'm an entrepreneur, and I've started now multiple businesses, and what I can tell you about my businesses is I know where my weaknesses are in each one of these businesses. I know who the key personnel are in each one of these businesses. I know how they work, right? The thing is that, the largest business I have is still like maybe $15 million in revenue. These are relatively small businesses, right? Now, if you buy a building, if you're getting into a larger business and now you have several hundred or 1,000 employees and it's got a $50 million revenue or $100 million revenue, it becomes less and less about one or two key people. The scale itself creates a level of safety as an investor, right? What I know from small business is that I would never buy a business, that was probably less than $50 million in revenue. I just wouldn't do it. I think it's dangerous to do that. And I think you can have the same kind of perspective on real estate, whereas the larger the asset, generally speaking, there is a greater stability, not only from the fact that, you can have, 95% occupancy in a 300 unit building and have that your goal, instead of having, either, your single family home, you get 0% occupancy or 100% occupancy, or, if it's duplex, it's 50%. You got one roof per house, one furnace per house. I mean, it's not scalable. And for me, over the last decade, the biggest single thing that has changed in my view of the world in terms of finances is scale. And if you're not careful, you can cap yourself pretty quickly in terms of your own abilities and your own money. So.
Yeah, I agree completely. I think the listeners, this has been a reoccurring theme on this program, is the scalability of commercial real estate. But you just touched on a couple things. You said it in a way that I haven't quite said it. Basically, when you're looking at single family houses, you're talking about a binary cash flow situation. Either you're 0 or you're at 100%. And that just doesn't lend itself to most of the goals that most people are investing in real estate for. Predictability, cash flow, dependability, being able to predict where you're going to be down the road. That is just not the case. Now, if you have a 300 unit product where 10 people move out, you're still in a cash flow positive situation. Most investors wouldn't even know that those 10 people moved out. And I think that you're lending yourself to all the right reasons to continue to move into those higher properties. So let's talk about what you're currently investing in. You mentioned 300 units or so. What are some of the profile of the deals that you're seeing as being advantageous right now? What markets are they in? What's the risk profile, et cetera?
Well, in terms of multifamily, typically it's going to be over 200 units. The group I work with primarily, we're the second largest owner in Phoenix of multifamily. We're presence in a lot of Texas, Atlanta, major markets. They're not New York City, but they are what I would still consider, for the most part, primary markets. They're not, Oklahoma City or Tulsa or something like that. For me right now, I understand that I think a lot of people understand we're sort of in the ninth inning of the housing cycle. And, I don't expect necessarily a 2008 sort of explosion, but I do think it is very smart to be very careful with what you're investing in. Let me give you some examples of what I think is dangerous right now. There are, like some groups, for example, in Dallas and stuff that are really just educational groups that are putting together a lot of non-accredited investors and sponsoring multi-million-dollar deals. And then the asset itself might be managed by, somebody who has a full-time job as an engineer or something, but, they are the person who's supposed to be the asset manager behind a $20 million project that it's bought, that is cash flowing at 80% LTV with Fannie Mae non-recourse debt, right? Okay, say they're cash flowing with debt, they're cash flowing at 7% or something like that. Who knows? The problem that I foresee in situations like that, which doesn't on the surface sound like the most terrible thing ever, is that a lot of these properties in Dallas right now, if you look at C class or C plus class properties, are trading at a cap rate around maybe mid fives or low fives. And the thing that I think that people are not paying enough attention to, because they either weren't involved with real estate in 2008 or they have a short-term memory, is that regardless of whether there's cash flow or not, if you have a larger asset like that, a cap rate decompression will create a lot of danger of losing that property, and whether you're cash flowing or not. Why is that? Well, the Fannie Mae, the banks are going to appraise that property, do an appraisal on that property probably every 18 months or so, right? And if your loan covenant says that you're at 80% LTV, that's what the loan covenant is. And I don't care if you are cash flowing or not. If you have a decompression of a cap rate and all of a sudden you are over leveraged because the value of the property went down, you're going to get a capital call, right? I talked to Robert Kiyosaki about this very thing. I remember him talking about a building he owned in Phoenix. I should just point out, I've gotten very lucky. Robert, I got to know him a little bit. I got to know Ken McElroy, who I learned from reading his books. I've gotten, I can call him my friend. But I remember Robert telling me that he got a call from a bank on a commercial property that he was cash flowing like $20,000-$30,000 a month on, or something like that. And the bank calls him and says, "Hey, we need you to put some money in here." And he's like, "What, are you kidding me? I'm just making a ton of money. Why would I do that?" And he said, "Well, we did an appraisal on your building and it's not worth as much as, it used to be. And you have it on such and such amount of leverage." Now, of course, Robert can flip the bill on that, no problem. But guess what? There's going to be people who can't do that, right? And that's where I think there's a real danger. I really do. Now, that didn't answer your question specifically about what I'm doing, but I wanted to set that as a background to understand that I think the most dangerous thing that could be done in this market right now is over leveraging. Okay. So how do you invest in something and get decent returns, yet be very careful about your leverage? That's really the question and the challenge. And to me, I am right now, especially only looking at properties that have a strong value add component. Why? Well, first of all, we want to be moderate about the leverage we take. Maybe you don't take 80% LTV. Maybe you get an 80% loan covenant, but then you're only taking 70% or 72%. And in the meantime, your entire business plan is to come in there and drive up net operating income. Why? So basically what you're doing when you're driving up net operating income, you are deleveraging, right? So you take a little bit of leverage, take it a little bit less leverage, and then you deleverage by continuously driving up net operating income. I do not think that we are in an economy right now where it is safe, in my opinion. Now, there's people who differ with me on this. There, you can just buy something, cash flow from day one, and not try to drive up net operating income significantly. But that is my perspective on this. So
yeah, you just touched on a ton of things, all of which I'm really interested in, and also really sympathetic to, particularly as it relates to leverage. I mean, the goal is to protect capital right now, given where we are in the cycle. The way you do that is to focus on acquiring conservative and appropriate debt. And it's something that isn't as simple as loan to value. It's something that isn't as simple as debt service coverage ratio. You have to look at the entire capital stack, mostly the debt, and understand and get conservative financing so that you can weather those storms if you do have cap rate expansion, which most of us are predicting. Now, there's some arguments to say that there's a lot of demand for this product, and the multifamily sector is certainly had an incredible run up because of the demand. It's really about the demand for the product, especially recently. Now, there have been cap rate compression, but still the demand is really solid. I think that thesis is in place. The challenge, to your point, is regardless of the demand, regardless of the rental income, if there's volatility in the market and that liquidity dries up, people are going to have a real serious problem, especially if you're doing things like syndicating opportunities. You have 100 investors. Everyone has to cough up an additional 30 grand. It's going to get really challenging in some of those markets where there's a lot of development taking place, especially. That brings me to something you mentioned earlier, 2 points about what you just said that I'm curious about. Number one, I know that you follow economic trends a lot. You have a lot of people on your podcast related to that. You mentioned that you're not really anticipating a 2000-like crash, and you're not poised for that. I am sympathetic to that. I agree with that. But I'm interested to hear why that is. What is your perspective on that? And why do you think that we're due for a correction, but nothing to the extent of what we saw 10 years ago?
Well, I mean, the economists that I listen to mostly will tell you that I think the banks themselves are not over leveraged like they were, right? And that was probably the biggest problem that we had. There is and then you didn't have quite the housing mania this time around that you did before, particularly for us real estate investors. And if you're talking about specifically about multifamily, one of the things I found interesting, and maybe this is one of the shows you might be referring to, is I was talking to, recently I had Doug Duncan, who's the chief economist of Fannie Mae, back on the show. And he'd been on a year before, so it was nice to get some contrast of the situation. But, we talked a little bit about multifamily and what's going to happen and, what Fannie Mae is predicting. And I think that the economy as a whole, I think that debt and slowly rising rates and all these things are serious, things that are probably going to result in some corrections, certainly in the equity markets. But one of the key things that we have as an advantage in the real estate markets is a huge demographic need for housing. So that to me is a little bit heartening, because I think that we continue to have, heavy demand for housing, population growth, et cetera, that I think that for the most part, if we don't over lever in the coming, next few years, I think we're going to come out just fine. So.
Yeah, that makes sense. And obviously, having someone like Doug Duncan on the podcast is definitely going to, expand your knowledge on things like that. There's not a lot of people that have as much data as someone like that. So very cool. Let's talk about the book real quick. Let's talk about some of the key principles there, some of the key takeaways that you mentioned. What are some of your thoughts on, why you wrote that book, and then some of the real meaty pieces of that book that you could share with us today?
I think that the book is actually fairly simplistic. And what I wanted to do is try to create something that, my colleagues, my former colleagues, I should say, the doctors and the lawyers and even the MBAs or whatever, people who just been in school and also are making money, just to give them a little bit different perspective. Now, for your audience, for the most part, that's not going to be, there's probably nothing in there that is earth shattering. I think that what I'm trying to do is, listen, I think that I have this view on education in general, and it's parallel to what Robert Kiyosaki talks about, where you don't get financial education in school, et cetera. Well, it's true, and it's not just the high-paid professionals; it's everybody. It's just the high-paid professionals actually have some money, so they need to know about stuff.
That's a really good point, actually. That's an important distinction. And that's why this problem actually exists. Most people don't have financial education, just doesn't matter because they don't have capital in the bank. That's a really important point.
Yeah, I mean, it's just a generalized problem. Now, here's where I think I'm going off course on the book a little bit, just to give you some background. I think that most people, again, who are in the situation of being highly educated, big time, professionals, and you're a surgeon, you're a high flying attorney, whatever, you're focused on your stuff, and you just spent your whole life learning these things that other people have been teaching you. And the reason that you're doing extremely well is because you were able to absorb what people taught you. And the challenge for those people, and this is an interview with Robert Kiyosaki that I did, I mentioned this to him, I truly believe that it is even more challenging for a highly successful person who's been successful in school, like a doctor, like a lawyer, like an engineer, whatever. It's even more challenging for those people to think outside of the box than it is for somebody who just wasn't very good in school. Why? Because you're so conditioned to just take what people tell you and learn it, master it, and get a pat on the back. The problem is that when you get out of school, there is no formal curriculum anymore. So if there's no formal curriculum, what do you have to master? The only thing you have to master is conventional wisdom, right? What are you supposed to do? And the problem with conventional wisdom is that it can be wrong. The world, in fact, is not flat, right? And in fact, the food pyramid that was on your wall in grade school, it certainly was on mine. As a physician, I can tell you that food pyramid is all wrong, and that it was based on a Harvard study funded by the sugar industry. And the sugar industry did not want anybody to know that there was a correlation between cardiac disease and sugar. So not only can conventional wisdom be wrong, but it can be the product of special interests. And so when I look at financial education or financial conventional wisdom, it is the product of special interests. Conventional wisdom is a product of special interests, which in this case is Wall Street. So the problem in trying to convince somebody who through their entire life has made a huge success for themselves doing what they're supposed to do is to tell them that the thing in front of them that they're supposed to do is wrong, right? So the bottom line is that my book is taking a step back and just saying, okay, let's just take this apart for a second. Now, if you were, and this is not the way I approach it, but if you were just approaching this whole issue of creating money and wealth what would you be thinking about? Would you be thinking about stocks, bonds, and mutual funds and derivatives and things like that? Or would you be thinking about buying real things that maybe the cash flow, things that maybe you understand a little bit, things that you can see, feel, and touch? Things that don't disappear when a bank, basically just goes out of business. You don't end up losing what you own because of somebody else's mistakes. That's the approach that the book takes. It's just common sense. I think for your audience probably is very simple. But for me, the reason for writing it is that there's this entire demographic that I just talked about that need a swift kick in the butt and saying, hey, this isn't the only way to look at the world.
Yeah, I think that's an important distinction, because if you are able to be a high-skilled professional, you're able to leave college, make a solid six-figure income, things have been going well for you since pretty early on, most likely. They've been intelligent their whole lives. They've been able to make good grades in school. They get out of college, they're doing okay or great. But to even get to that next level, it's going to take a completely different level of skills, a completely different skill set entirely to really become a business owner and an investor, which is really the whole point of that Kiyosaki book. It's actually a good segue into the Investor Club, which is something that you have. Let's talk a bit about what the Investor Club is and what types of investments you're seeing right now, real estate or otherwise, that you're really bullish on.
Well, Investor Club is just my community. Wealth Formula has got this, part of it really was that, when I was doing all this investing and really started focusing in on things that were doing well for me, I had a lot of people who were interested in finding out what I was doing, and other high-paid professionals, so accredited investors. So when I started the podcast, which for me, by the way, was just my journey, sort of kind of the stuff that I wish I had after I read Kiyosaki's books, I just decided, well, hey, I'm going to just open the door to people who are interested in learning about what kinds of things that I'm doing personally. So it's an accredited investor group. It's we just call it a club, because who doesn't want to join a club, right? I mean, that's
right.
So it's just basically just my email list, and we look at deals together. Some of the things that I might be doing as a joint venture, some of the things I'm not, that I might be personally interested in. And so, yeah, I mean, it's largely, I would say, largely real estate focused for the most part. Some multifamily, some self-storage, the usual suspects. But then we'll have a few weird things in there. We'll also have, webinars that are highly specific to people with a little bit more money, whether that be regarding asset protection, estate planning, or taxes, things like that. So lots of different topics.
Very cool. And there's just so many topics that I want to get to, but one in particular, I heard an interview where you mentioned that you have investments in whole life.
Yeah.
And I have had a couple of people come on the program to talk about whole life as a cash flow management system. But it's my understanding that this is not the side of the investment that you have made. So give us an example of what this investment in whole life is, and then we can also potentially talk about whole life on the other side of the argument, first of all.
I think it's probably pretty similar to what a lot of your guests, I'm presuming they talked about infinite banking and those kinds of things.
Yes, correct.
Yeah, I mean, so we do this, we call it Wealth Formula Banking, because we like to always call everything Wealth Formula just for fun. But the idea behind the way I like to do it is I don't really think of, borrowing money to buy a car. I don't think of, like, once you overfund something and you've got a cash value to it, I don't think about it the way that Nelson Nash's book, talks about things like buying things and everyday things. I think about using it as an extra leverage tool.
Right.
So what I like the idea of is, borrowing from it. So one of the things that you probably know, certainly a lot of people don't know, is that, say your money is growing in your whole life policy, I'd say it was like 5.5% or whatever, compounding, that if you borrow it, you're borrowing money. You're not borrowing it from your own account, your cash account. You're borrowing it from the general insurance account, right? So you're not truly borrowing your own money. You're just collateralizing it, basically, right? And so you may take a loan out and they might have a 5% interest on it, but the 5% interest that you are borrowing at is a simple interest. It's not a compound interest. So what you're doing there is, if you invest in something using that money, you're investing, what you're doing is you're creating additional money from two places at the same time. You're investing the same money in two places at the same time because you've got a component of this money that continues to grow at a compounding rate. Meanwhile, you're borrowing at a simple rate, and then you're investing in something else that creates cash flow to pay off the initial debt. So that's the way I think it's best used. That's my opinion. I'm not sure what your difference is with that.
Yeah, no, we've actually had a couple of the thought leaders in the space. Bob Murphy, who I'm a huge fan of. I'm not sure if you're familiar with him. He's an Austrian economist that I am a big proponent of. He came and talked about the program. It's always interesting, though, because I haven't yet done that. I've spent a lot of time thinking about it and looking into it. So it does sound like you are an advocate of it, and you do have your clients use it as well. Is that correct?
Oh, yeah. Yeah. I mean,
okay.
And we explain this. If you're curious, we have our own webinars on this at wealthformulabanking.com, where we go into a lot of detail, and we actually use, actual, properties and project, based on whether you did this just from your savings or if you bought something using some kind of a cash flow banking model, which we call Wealth Formula Banking. But to me, it's a pretty easy thing to tack on that pretty much just adds returns to what you're already making. So to me, it's like the other thing is the way we have these things, the way my guys put these things together. And I don't know if this is what you've seen, but I mean, you only have to keep that money that you initially put in there. The majority of it, if you want to, you can borrow it out in as little as 30 days. So it's not like it's gone forever. So sweeping it through a whole life account, I think makes a lot of sense. I think it can be very, can just basically create one more source of leverage, which I'm a huge fan of using leverage in a smart way. So.
Okay, cool. Yeah, I didn't even know that we were going to get onto that topic, but I'm interested. I'm glad that we discussed it because it's always good to know another data point. One of the guests that we've had on this program, one of my favorite episodes we recorded is with Cameron Herold. When it comes to entrepreneurship and business and systems, I can't think of anyone that I really, really look up to more than him. I know that you are also a member of the Genius Network, and I wanted to talk briefly about that. What is, just from a personal standpoint, because I'm interested in potentially including that in something that I'm doing. What are your thoughts on that? What has your experience been? What's the key takeaway? And before you answer, I want to say that my challenge with joining that has been that it does seem like there's a vast variance of the types of entrepreneurs that are in that group. And if you're going to be paying a significant amount of capital, I want a significant takeaways, but it sounds like the networking component is the real takeaway. I just wanted to ask you one quick question about that because, when else am I going to get to talk to you about the Genius Network?
Yeah. Well, I think, for me, Genius Network is just one of a few different masterminds that I've been a part of, either, have previously been or part of or am a part of. It's not what you learn at Genius Network, right? It's really not what you learn at any of these masterminds. Usually, and I think you just mentioned it, it's the people, right? You tend to, the money that you make, Joe Polish, he's the one who's Genius Network, it's his, right? His whole thing is if you can't make $250,000 extra in a year because of the $25,000 that you spent to be in this group, then don't come back, right? And it's funny because if I think about it very simplistically, I might not have done that, but then I realize who I've been working with on various projects, and I'm like, oh yeah, I killed that, right? So it's like anything else, though. I mean, listen, you have to go in there and you have to really, I think you just have to find the people who are going to have some mutual benefit with you. I mean, I found some people who have mutual benefit with, my COO was part of his group for a while. I know Cameron well. It's just, but I don't think it's for everybody. I mean, I really don't think it's for everybody. I do think it is a group that's really driven by marketing. You've got to use it like in anything. You have to really try to get something out of it.
Yep.
That's true with any mastermind I've been part of. So
particularly financial education, right? I mean, there's plenty of people that may be listening to this podcast right now that haven't yet invested in a deal. You have to leverage the knowledge with the action. In this case, you have to leverage the network with the action. With that in mind, Just real quick, what books, what resources are you looking at right now? What are some of the main resources that you're getting your information from? Or if you read any recent books that you really wanted to share with our network, I'd love to hear.
I get so busy reading like books of people who have been on or coming on the show. It's sort of hard to, like for example, Nomi Prinz was on not too long ago. Collusion reads like it reads like a textbook, but it's very interesting. I think, so whenever we have somebody new, I'm always kind of reading their book. So I can't say that I necessarily have one that has hit me like a ton of bricks lately, but I think reading Nomi Prinz books is probably pretty interesting if you're into the whole global economy and central banks and how they really control the world and how we really don't count.
Right.
I think that's probably she's got some great stuff, especially if you're like a fan of like Jim Rickards and stuff. And Jim Rickards' books are always interesting. I mean, they'll make you feel depressed at the end of the day. But I can't even remember the names of these books. But look up Jim Rickards. I read all of Jim's stuff, and he's also been on the show. He's very smart guy. One thing I'll tell you though is that I think it's important to balance what you read and what you consume. I think that, in my niche, and maybe this is yours too, I'm not sure, but there is a strong tendency of people who are constantly saying that the sky's falling. I think it's really important to make sure that you mix up your perspective, because there's people I listen to who've been talking about the economy crashing now for the last 7 or 8 years. And if you did nothing in the last 7, 8, since the last crash, since, 2010 or 11 or whatever, you'd feel pretty foolish right now if you sat on the sidelines the whole time, right?
Mm-hmm.
Really have to use your mind. You really have to spread out the content that you consume and not get caught up too much in one rabbit hole, one type of thinking. Otherwise, you can potentially miss out on opportunities.
Yeah, I agree completely. Now, before we wrap up, just one question about young entrepreneurs that are just entering the space or new real estate investors. If you could give current investors, new investors, one piece of real estate advice, what would it be?
Well, here's what I'll tell you. I think that at the beginning I talked about my mistakes, right? I mean, and how I learned an enormous amount, and that was a decade ago. And I mean, it's just like you said. I mean, some of these mistakes are ridiculous when you hear them, but gosh, everybody's got to learn somewhere. You start from nothing, and that's part of the intimidation factor of people getting in. You're always going to learn from mistakes. The key thing to understand is that they don't need to be your mistakes. And to the extent that right now there are plenty of people that if you're interested in investing, that you can listen to podcasts, and my listeners, typically a lot of them are busy professionals and they want to invest in things, but not really get their hands dirty. So they can invest alongside things that I'm doing. And I'm sure that's the case for your audience as well. I think the bottom line is, don't get too enamored with, this sort of idea of, as much as I love Robert Kiyosaki, I think one of the things that ends up happening is that people read the books and they immediately think they need to go out and buy a house themselves. Even if I've got guys who make $2-3 million a year and they had the first thing and they're deploying $10,000-$15,000 to buy a single family home. That is not going to move the needle for you.
Right.
So everybody's different. Try to just keep listening and learning and become part of a tribe. And that's what I always advocate. The math for wealth is easy. It's a product of putting money in to invest. We call it math. It's velocity of money, how quickly you get that money back, and finally using leverage in a very smart way. That's all easy. The hard part is everything else. And in order to be successful, it's a good idea to be part of a tribe.
Before we wrap up, I agree completely with that. What is some of the ways that investors can learn more about you, your group, and how they can get in touch with you?
So there's the podcast, of course, Wealth Formula Podcast. There is a lot of information on there. We tend to focus very much on education. Definitely not a podcast where people come on to pitch deals and stuff like that, because I don't allow it really. But it's mostly, authors, economists, things like that I think you can learn a lot from. So that's Wealth Formula Podcast. You can also go to wealthformula.com. If you do want a copy of that book, you can get a copy of 7 Secrets of Eternal Wealth there, or just text me too at 44222 and type in Wealth Formula, one word, and you can get a copy of 7 Secrets, although for most of your audience, it's probably fairly simple. So,
okay, well, we will have all of that information in the show notes page. Buck, I really appreciate you coming on, and thanks again. Let's have the same conversation, different topic in a few months. Talk about something else.
You got it. Thanks for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.